Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week, we're covering California conformity to certain provisions of the Federal Disaster Tax Relief Act. Spiedel's federal and California tax update is the best 8-hour update to prepare for tax season. Learn about the recent beneficial ownership reporting updates, using AI in your tax practice, conformity issues, and more. Get registered for a live seminar or webinar session at caltax.com. On December 12, 2024, President Biden signed the Federal Disaster Tax Relief Act of 2023. The FDTRA provides retroactive relief to victims of certain federally declared disasters. Two provisions of the bill are of particular concern to California taxpayers. The FDTRA provides a gross income exclusion for qualified wildfire relief payments. The relief applies to any qualified wildfire relief payment received by an individual during the 2020 through 2025 taxable years that's related to a federal disaster declared after 2014 as a result of any forest or range fire. For tax years for which the statute of limitations has expired, taxpayers can file a refund claim for up to 1 year after the date of the FDTRA's enactment. A qualified wildfire relief payment is any amount received by or on behalf of an individual as compensation for losses, expenses, or damages, including those for emotional distress that were not already covered from other sources such as insurance. Because of California's January 1, 2015 conformity date, California does not automatically conform to the changes made by the FDTRA. But California has previously enacted legislation that excludes some wildfire settlements related to certain wildfires. For pre-2028 tax years, or pre-2027 tax years for the Thomas and Woolsey fire settlement payees, California excludes from gross income for both personal income and corporation franchise tax and income tax purposes settlements paid by PG&E and Southern California Edison to qualified taxpayers who were victims of the following wildfires: the 2015 Butte Fire, the 2017 North Bay Fires and Thomas Fire, the 2018 Camp and Woolsey Fires, the 2019 Kincaid Fire, and the 2020 Zogg Fire. For the Butte, Camp, and North Bay fire victims, the exclusion only applies to amounts paid from the Fire Victim Trust established pursuant to the order of the United States Bankruptcy Court for the Northern District of California. The exclusions apply to PG&E or Southern California Edison settlements paid to all taxpayers who owned real property or resided in or had a place of business in the impacted counties and paid or incurred expenses and received amounts from the settlements. During the 2024 legislative session, Governor Newsom vetoed SB 542. SB 542 would have excluded from gross income settlement amounts received for the 2021 Dixie Fire in Butte, Plumas, Lassen, Shasta, and Tehama counties, and the 2022 Mill Fire in Siskiyou County. However, the governor requested that this be considered again with the 2025 budget bill, so relief may be coming next year for settlements related to the Dixie and Mill fires. The FDTRA allows individual victims with a net disaster loss from any taxable year to claim an enhanced personal casualty loss for federally declared disasters that occurred after February 24, 2021. These enhancements remove the 10% AGI threshold, increase the $100 per casualty limit to $500, and allow non-itemizers to increase their standard deduction by the net disaster loss. This relief is available for any federally declared disaster occurring after February 25, 2021 through February 10, 2025, including but not limited to Hurricanes Debby, Ian, Helene, and Milton, as well as numerous storms and wildfires throughout the United States. California never conformed to the TCJA provision that suspended the personal casualty loss deduction for the 2018 through 2025 tax years. Taxpayers can still claim a personal casualty loss on their California return pursuant to the pre-TCJA federal personal casualty laws. California also does not conform to the FDTRA enhancements to the disaster-related casualty loss. This means the casualty loss related to a disaster is still subject to the $100 and 10% of AGI thresholds and cannot be claimed by taxpayers who claim a standard deduction on their California return. We have a detailed discussion of California conformity to the Federal Disaster Tax Relief Act in the January 2025 issue of Speidel's California Tax Letter. For subscription information, visit caltax.com and click Publications. That's all for this week. Join us next time for another episode of Speidel's California Minute.